If you turn 71 this year, the government is about to force your hand on money you've spent decades saving. And if you don't plan it right, you could hand thousands of extra dollars to the tax man without even realizing it. Concerned. Before we get into this, if you find this channel helpful, please take a second to subscribe. It genuinely motivates us to keep bringing you accurate, up-to-date pension and retirement content, and it costs you nothing. Sincere. Welcome back to CPP OAS Weekly Update. Today we're talking about one of the most important and most misunderstood deadlines in Canadian retirement planning, the RRSP to RRIF conversion. If you're turning 71 this year, or if you're getting close, or even if you're helping a parent or a spouse navigate this video is for you. By the end, you'll know exactly when you need to convert, how much you'll be forced to withdraw, and most importantly, the mistakes that could cost you thousands of dollars if you don't plan ahead in 2026. Let's start with the basics, because even though many of you have had an RRSP for 30 or 40 years, the rules around what happens to it later in life are surprisingly not well explained anywhere. Your registered retirement savings plan, your RRSP, cannot stay an RRSP forever. The Canada Revenue Agency requires that it be converted into a retirement income vehicle by December 31st of the year you turn 71. Not your 71st birthday, not the following January, December 31st of that calendar year, no exceptions. Here's a small fact that surprises a lot of people. There is no minimum age to convert. You can convert your RRSP to a RRIF earlier than 71 if it makes sense for your situation, but you cannot go later. Miss that deadline and the entire RRSP is deregistered and treated as fully taxable income in a single year. That is a mistake that has quietly devastated retirement plans, so keep that date circled. Now, most Canadians choose a RRIF, a registered retirement income fund, as their next step. But it isn't the only option, and I want you to know all three because your financial institution won't always walk you through this clearly. The first option is converting to a RRIF, which is by far the most common choice because it keeps your money invested and growing while giving you flexible, ongoing income. The second option is purchasing an annuity, which is a contract with an insurance company that pays you a guaranteed income, either for life or for a set number of years. The third option is withdrawing the entire RRSP as a lump sum. I want to be very clear with you. This is almost never recommended because the entire amount becomes taxable in that single year, which can push you into a much higher tax bracket overnight. Now, here's something that catches a lot of people off guard, and it's one of the biggest points of confusion I see in the comments every week. Converting to a RRIF does not mean you have to start withdrawing money immediately. If you convert in 2026, your first mandatory withdrawal isn't required until 2027. That gives you a small window to plan your first year properly rather than scrambling at the last minute. So let's talk about the number everyone actually wants to know. How much will you be forced to withdraw each year? The RRIF minimum withdrawal is calculated using your account balance as of January 1st of that year, multiplied by a percentage that is based on your age. This percentage is set by the government. And here's the part that matters most. It increases every single year, automatically, regardless of how your investments are performing. Let me give you a real example using current 2026 figures. If you're 71 years old at the start of the year and your RRIF is worth $250,000, your minimum required withdrawal is roughly 5.28%. That works out to about $13,500 that year. Whether you need that money or not, whether the market is up or down that year, you are required to take it out. Now, here's a curiosity worth sitting with for a moment. What happens if the market drops the year before your withdrawal? Does your required withdrawal amount shrink too? The answer is yes, but not in the way you'd hope. A down market does lower the dollar value of your RRIF, which does lower your withdrawal in dollar terms. But it does not lower your tax obligation on a percentage basis, and it permanently shrinks the pool of money that all your future withdrawals will be calculated from. In other words, a bad year in the market early in retirement can quietly follow you for decades. Let's look at how these percentages climb as you age, because this is where careful planning really starts to matter. At age 71, your minimum is a little over 5%. By your late 70s, it climbs into the 6 to 7% range. By your mid-80s, you're looking at minimums well above 10%. And once you reach 95, the required withdrawal jumps to a full 20% of your RRIF balance every single year. Think about that for a moment. At 95, the government requires you to pull out 1/5 of your entire retirement fund in a single year, no matter what. This is exactly why so many retirees get an unpleasant surprise in their 80s and 90s. Their RRIF minimum, combined with CPP and OAS, suddenly pushes their total income much higher than expected. And that brings us to the mistake that cost Canadians the most money in 2026, the OAS clawback. Here's how this works, and I want to explain it slowly because this is one of the most important numbers in your entire retirement plan. In 2026, if your net income for the year goes above $95,323, the government begins clawing back your old age security payments. For every dollar of income above that threshold, you lose 15 cents of your OAS, and your RRIF withdrawals count fully toward that income calculation. So picture this scenario. You're in your early 80s. Your RRIF minimum has climbed to 8 or 9% of a healthy six-figure balance. Add in your CPP, your OAS itself, maybe a small workplace pension, and suddenly your net income creeps past that $95,000 line, even though you never spent a dollar of it. You just left it sitting in a savings account. That's the trap. The RRIF forces income recognition whether you need the money or not, and that income can silently trigger a clawback you never saw coming. Now, let's get into the strategies, because this is the part that actually protects your money. The first strategy, and one that surprisingly few people know about, is the spousal age election. Before your very first RRIF payment is made, you can choose to base your minimum withdrawal calculation on your spouse's age instead of your own, if your spouse is younger. This one decision, made at the right moment, can meaningfully lower your required withdrawals for years to come. But here's the catch. Once you make this election, it is permanent. You cannot change your mind later. So this decision needs to be made carefully, ideally with a financial advisor, before that first payment goes out. The second strategy is something financial planners call melting down your RRSP. Instead of waiting until 71 and being hit with the full mandatory percentage right away, some retirees choose to take smaller voluntary withdrawals from their RRSP in their 60s, especially in years before CPP and OAS begin, when their income is naturally lower. This spreads the tax hit out over more years at lower tax rates instead of concentrating it all in your 70s and 80s when the percentages are much higher. Here's a small but important curiosity most people miss entirely. Did you know that only amounts you withdraw above your RRIF minimum are subject to withholding tax at source? The minimum amount itself is not withheld, but it is still fully taxable when you file. That surprises a lot of retirees at tax time, so keep that in mind. The third strategy involves your TFSA. If you have room in your tax-free savings account, consider using it to supplement your income in high tax years, rather than pulling out extra money from your RRIF above the minimum. Why? Because TFSA withdrawals do not count as income for OAS clawback purposes. That makes your TFSA one of the most powerful tools you have for controlling your net income and protecting your old age security. The fourth thing to seriously consider is pension income splitting. If you're married or common law, RRIF income qualifies for pension income splitting on your tax return, which means you may be able to shift a portion of that income to your spouse's return if they're in a lower tax bracket. This alone has saved many retired couples significant money at tax time. Let me pause here for a moment, because I know this is a lot of information, and if you're turning 71 this year, this might feel a little overwhelming. That's completely normal. This is genuinely one of the more complicated corners of retirement planning, and you are not expected to figure it all out alone. Here is a simple checklist you can follow, step by step, well before that December deadline arrives. First, confirm with your financial institution that your RRSP will be formally converted to a RRIF before December 31st this year. Second, ask them to calculate exactly what your mandatory minimum withdrawal will be in your very first RRIF year. Third, add that number to your expected CPP, your OAS, and any other income sources, and check whether the total puts you above that $95,323 clawback threshold. Fourth, if you have a younger spouse, ask specifically about the spousal age election before your first payment is processed, since once it's done, it cannot be undone. Fifth, if you have TFSA room available, think about using it strategically to reduce how much you need to pull from your RRIF in high-income years. And finally, sit down with a financial advisor or a tax professional, ideally months before the deadline, not in the last week of December when everyone is rushing. I know all this can feel like a lot, especially when it involves decades of savings you've worked so hard to build. But here's the reassuring part. None of these rules are designed to trick you. They're simply rules that reward planning. The retirees who come out ahead aren't the ones with the biggest RRSPs. They're the ones who understood these deadlines and made a few smart decisions early before the mandatory withdrawals began climbing year after year. If there's one thing I want you to walk away with today, it's this. The RRSP to RRIF conversion isn't something to fear, but it is something you cannot afford to ignore. A little bit of planning now in 2026 can protect your old age security, lower your lifetime tax bill, and give you real peace of mind for the retirement years ahead. If this video helped clear things up for you, please give it a like and leave a comment below telling me how old you are and whether you've already converted your RRSP or if this deadline is still ahead of you. I read every single comment and it genuinely helps me know what to cover next. And if you haven't already, please subscribe to CPP OAS Weekly Update. We put out new videos every single week covering exactly these kinds of practical, real-world topics that affect Canadian seniors. Next week, we're going to break down another topic a lot of you have been asking about, so make sure you're subscribed with notifications turned on so you don't miss it. Take care of yourselves, and I'll see you in the next video.